Hi, my name's Kieran Wilson. This is
Thomas Pritchard, and today we'll be delving into a £100,000 investment portfolio and looking at the efficient market hypothesis and how this affects creating investments for this portfolio.
Let's get into it.
On to the content of what we'll be covering today. This is a brief overview of everything that we will be covering, starting with the introduction and then to the investment types we'll be making, how the efficient market hypothesis will work. Then we'll explore different investment options and portfolio examples. We'll also discover our clients' goals with the money that's being invested. And finally, the methods that we'll use to measure the investment type success. To begin, it's crucial to understand the landscape of investing. So what we'll be talking about is how the different possible investments and how the investment types have a level of risk, return, liquidity, and what the diversification and the tax implications would mean on the money that they've invested. Ultimately, of course, the goal is for the investment portfolios to balance a risk and return while considering the factors that will play into achieving a healthy return without the excessive risk that comes with investing. So, what is the efficient market hypothesis? Let's dive into a key concept in finance, which is the efficient market hypothesis, or EMH. The efficient market hypothesis states that the share price reflects all available information from a business. This also means that all past information isn't relevant, as we're only looking at what the business is currently performing. In simpler terms, it suggests that it's difficult to consistently outperform the market because prices are already incorporated with all known information. As mentioned earlier, past information isn't relevant for this. Market Tracker is the best way to invest if you believe in the efficient market hypothesis. The EMH has several important implications for investors, as it suggests that in its weak form, technical analysis is ineffective as price reflects past information. The semi-strong form mentions that fundamental analysis has limited value if the information is already public. And with the strong form, even insider information may not guarantee a superior return for the investor. As a result of EMH, investments can be diversified, and they should be. If markets are not 100% efficient, it is very hard to beat the market consistently. Before we go further, let's define what we mean by an investment. An investment is an asset or an item acquired to generate income or gain appreciation. Appreciation is the increase in the value of an asset over time, leading to more money. It requires the layout of a resource today, like time, effort, and money for a greater payoff in the future, generating a profit. Whilst investing is great for money, there does come a risk and reward scale, meaning the more risk that there is, the more likelihood of you making more money, whereas the lower the risk, the less money you'll make, such as in a savings account where you may get a percentage on how much money you make through the year, and with the government bonds where the money stays in there but you do have a chance of getting money from the government. Although when you go to the left and you see the higher risk, you can see that with the penny stocks and the cryptocurrency, you will make more money because there's a higher risk and a higher reward. And here we are. This is where we're speaking about the potential investment portfolio types for the £100,000 and where this will be distributed into. Let's take a dive into this now. So, starting with our known investment portfolio type with Warren Buffett's strategy. It's simple. Put 90% in a low-cost S&P 500 index fund and then the other 10% in a short-term government bond. This will lead to the 90% slowly but surely gaining money with the S&P 500 index, which is where the money is invested equally between the top 500 businesses. And then your other 10% will be in a short-term government bond, which will be risky but will lead to a quick profit. Paul Merriman's ultimate buy and hold strategy means that your money is more diversified into various market capitalizations and geographical locations. This means that your money will be fluctuating at a different rate, and in my opinion, it's a good way to invest your money, as other than with Warren Buffett's method, all of your money isn't diversified into 90% of a S&P and 10% of a government bond. This results in your stock and your portfolio being more diversified, resulting in different fluctuations and profits across the investment. So, looking at Ivy League endowments, this is a good investment type because this, again, is a diversified portfolio with significant allocations to alternative investment types like real estate and commodities. This is a good model because it looks at generating a consistent long-term return whilst mitigating the risk through diversification and leveraging expertise to access alternative investments, which can lead to strong performance with the investment. So this is the Coffee House portfolio, which again focuses on diversifying your portfolio, focusing on a fixed income and a mix of large cap, small cap and international stocks. As we can see here, 40% is coming from the fixed income, meaning that this will be heavily focusing on having the steady income constantly all year round. Also, with Bill Bernstein's no-brainer portfolio, this shows theory of equally allocating your bonds between both European, US small cap stocks, S&P 500, and also your bonds. This means that all of your money won't just be in one area and will be with equal risk all around on the portfolio. Harry Brown's permanent portfolio aims for stability in any economic condition with allocation to the US long-term Treasury bond, the US Treasury bills, the US total stock market, and gold.
One of the most important things when looking into an investment and an investment portfolio is what the client's goals are. If they want a high risk portfolio that potentially will lose them a lot of money but make them a lot of money, then we'll choose something like stocks and shares. Whereas if you want low risk, you'll put it in an ISA or a savings account. And this is tailored especially just to each person and their specific needs and goals with the investment. Next, we will be moving away from pre-made investment portfolios to investment portfolios we have made ourselves for this specific investment of £100,000. Starting with 20% ISA, which is £20,000 maximum. It's tax-free and it will give you a good steady interest rate. Commodity is also a good steady interest rate, but also very safe. Ordinary shares, a bit more risk, but they will also, if you pick the right businesses and the right companies, you will get that good steady incline in your cash flow and therefore will be a good investment. Overall, the first investment is a good level of risk return. Like it's not too much risk, but also will have that steady increase in your profits. There's great tax advantages because of the ISA. As I say, it's tax-free. Great liquidity because of the diversity in different investments. Could do with a few more different investments as there's only 3, but overall it's pretty good and good diversification. Moving on to the next portfolio, which is very, very low risk, is made up from 20% ISA, 40% savings account and 40% bonds. The ISA once again is tax-free and £20,000 limit, so you may as well use it because you can get really good returns on this and it's very safe. The savings account is 40% and you make 4.25% per year. And once again, this is a great safe place to put your money with a steady income. Bonds, 40%. This fluctuates way less than stocks and shares, so it's a safer place to put your money, and it depends what type of investor it is. But for the £100,000 investment, bonds are quite safe, and your money is going to increase gradually over time, but low risk. And the tax implications of this investment are really good because of the ISA. It's got good liquidity and also very good diversification. In this investment, we're going to bring in investing into UK businesses and real estate investments, as well as the use of 50% bonds and 10% savings. This investment is a very safe long-term investment. There isn't many tax implications, but the liquidity is very good. There's good access to the funds, and the diversity is quite good, involving businesses in the UK and real estate, which is definitely going to increase in worth over time. Moving on to investment 4, it is another very long-term and pretty low-risk investment portfolio using 50% bonds, bringing back in that 20% ISA, which is tax-free with a £20,000 limit. The money market funds of 20% and savings of 10% is good diversification. It uses a lot of different low-risk methods. While having the tax-free ISA, like I've said, it is very useful, and you may as well incorporate this into the portfolio. The liquidity is really good. The assets you can just access straight away, and it's going to be very useful in the long run with family issues and other investments. This is personally my favourite investment of them all. It's very, very diverse. Looking at index funds and real estate management and corporate bonds, there's a very wide range of different investments. It's got great liquidity. You can move your money around. No money's going anywhere. It's very, very steady income investments. So I highly suggest this. And the risk and return is, I would say, medium. There's still some risk to it. You've got EFTs in there and bonds, like they might go wrong, but overall, good amount of risk, good diversification, good liquidity. And I would definitely suggest this as an investment portfolio. Lastly, moving on to our final investment portfolio. We just chucked this in there just to show you an example of a very high-risk investment portfolio that is likely to be very unsuccessful. This is made of 30% growth stocks, 30% emerging stocks, 20% venture capital, and 20% crypto and EFTs. In this investment portfolio, you don't have any backup money. If all of these stocks and crypto goes wrong, then you've got no money left, and you're in a very, very bad situation, losing a lot of money. And we would not recommend this because of poor liquidity, poor diversification, and poor risk and return levels. Next, I'll be looking at 3 different ratios which help measure the success of different investment portfolios. First of all, the Trainer ratio, which provides investors with a composite measure of portfolio performance. This means you can standardize different portfolios and find out which is the best. Next, the Sharpe ratio, which finds the standard deviation of the portfolio. This is very, very helpful when comparing different portfolios and finding out which is going to be the most successful and which isn't, and therefore picking the best portfolio. Lastly, Jensen's Alpha, which calculates the excess return that a portfolio generates, which, again, you're going to find the best portfolio, and it's going to be very, very useful in the long run and with your returns of cash. Throughout this presentation, we have looked at investment types and their pros and cons. We've looked at pre-made investment portfolios, and we've made our own investment portfolios for the £100,000. We've also looked at ratios which we can use to assess the pros and cons of different investments and portfolios. Underlying all of this is the efficient market hypothesis, which says that no past information is important at all, and we only look at current information about the businesses, the economy, and other aspects like this when looking at the future of investments. This is our reference slide, and this shows where we found a lot of our information directed into this PowerPoint presentation, and it is all credibly sourced and very useful. Thank you for listening to our presentation. We hope you now have a greater understanding of different investment types and investment portfolios, and now have an idea where you are going to invest your £100,000, and we hope this was helpful. Thank you.